Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Wednesday, the 15th of June, Bull versus Bear webinar here. Steve Miley on the call for trade day. Welcome, everyone. So we're going to go for our usual regular run through in here today. I'm going to keep this fairly brief today because there's not a lot to say given we've got a huge event ahead of us. There are a few other little things going on. Well, there's one quite a big thing going on, actually, but we'll talk about that. But to be quite frank, we'll look at the charts, but it's going to be about reacting to the Fed. And I know we've got some trading to do before the Fed, but I'll be very cautious ahead of there. And then you're really reacting to Fed. So let's talk about, so clearly the Fed's the focus today. We do have had some light data in here, really not significant in here from Europe. Got some light data. We actually have retail sales out today. So the market may move on that. There may be some opportunities around retail sales, but is the market really going to move significantly? And there's no going to be, it's going to be all, very short-term day trade money. No one's going to be putting any money to work on a retail sales print ahead of, a highly anticipated meeting with the Fed today. Crude oil inventories. So just under an hour we get retail sales, crude oil inventories at 10:30 Eastern time, and then we get the FOMC in here at 2:00 Eastern, and then the press conference at 2:30. So that's going to be really the key that we're going to watch today. What we want to know about as well, if you're just waking up in the US, is it's not only all about, it says all about the Fed. Well, that's not the right headline. It's not only the Fed, because we have a surprise emergency European Central Bank meeting being called today. Nothing says crisis like an emergency meeting. So European government bond markets have been plunging lower in here, okay, since the last ECB meeting, just over a week ago, right? Just under a week ago, last Thursday. European government bonds have been plunging, and the spread between what we call the core in Europe, so the core is like the French and German bonds, and the periphery, which is kind of Italy, Portugal, Spain, everything else kind of stuff, has been widening. Yeah, so there we've been a widening of spreads. Okay. And then we've seen European government bond spreads in here. So the peripheral bonds are selling off even more aggressively than the German and the French bonds in here, widening the spreads out between those, the yield spread between those. And you've seen a super aggressive sell-off in bonds. Let me see if I can actually quickly just show you. I can show you even the futures chart. Where am I going to quickly get this for you? Hopefully this will work quite easy. I've got it on another page in here. You guys can't see, but let me see if I can quickly bring it across so you guys can see. Just bear with me so I can show you. Hopefully this will work. It may not though, but hopefully this will work. If not, I can find it pretty quickly. It might ask me to log in. Oh, no. I'm not logged in. No. Okay. Let me just add in the buns in here. FGBL. Okay, European government bond, but the bund future in here. The September contract. Why is this not opening? Why is this not opening as a chart? That's so annoying. From my watch list. Sorry, guys. We'll get there, but suffice to say anyway, bond markets are absolutely collapsed. Here it is. Okay, bond markets are aggressively low. Look at this. This is the ECB pretty much down here. Boom, 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 boom. So this is the German government bond. Okay, so they're absolutely collapsing here. Very, very super stable negative. And we've also seen the spread, the blowing out. That's important as well. That's moving significantly wider. So BTP Bund. Let me see if I can get that. Type that in up here. See if that works for us. No, it's not going to allow me to do that. I can probably get BTP. You can see in here, it's actually narrowed back in, and that narrowing we've seen back in. So this is it widening out, moving this way, is widening out. So it's been widening out and seen acceleration in here. So this is Italian governments underperforming, yes, selling off more quickly than their European counterparts in the core, and we've seen them move back lower, and that's because of the ECB meeting. Okay, so this ECB meeting is important. Is they're reacting, right? So they're reacting to this big sell-off. The worry for policymakers is very rapid repricing euro financials since last week's scheduled meeting, which promised a rate hike, is causing unjustified widening of borrowing costs. Okay, so that's the concern. Okay, and particularly into the peripheral markets. Okay, so again, look, markets fall out. Italian bonds and the euro rallied on speculation. Policymakers will give further details of how they plan to keep borrowing costs in the region's most vulnerable members in check. So the problem is the periphery, right? The periphery, Italian government bonds, Spanish, Portuguese, but in particular Italian at the moment, But then we've seen a reversal of that, as you just seen on that chart there today, because of speculation in here. So we've seen that pushing, widening out those spreads, and now moving back in, narrowing back in, and that narrowing back in. Okay, so this is important. I know you think it's all about the Fed, guys, but there are other central banks in play, and so it's not all about the Fed. Even though they've cut here all about the Fed, then they go on as talk about this emergency meeting, and then European government bond markets. Bitcoin again lower, nearly at 20,000. 20,000 was the target. Kind of a longer term buying target, only a week ago, and now we're there already. Okay, that was meant to be a target we could get down to in the next few months or whatever, and here we are in a matter of a few days. Real risk of this going lower in here. Coinbase yesterday announced layoffs. They cut just under 20% of their staff at Coinbase, and it's adding to contagion fears in here. So all eyes are going to be on the Fed. Let me just run through a few of the headlines in here. So European stocks jump on the ECB meeting. So they're taking relief. Okay, the fact that the ECB are in, they're going to do something to help out the peripheral bonds, the peripheral markets, borrowing, accelerating borrowing costs. ECB council to hold emergency meeting to address the market setup. Italian yields have surged above 4% this week. Spreads to the core widening. That meeting 11 a.m. So that means in progress. I don't think we've had anything out there. The meeting set place at 11 a.m. Frankfurt. Now Frankfurt is an hour ahead of where I am, and we're now 12:38. So it's at 1:30. It's at 1:40 p.m. now in Frankfurt. So they've been going for a while on that. So let's see what they come up with. We may get something this afternoon. It could be near where the Fed come out. EC meet to tackle rout in bond market amid echoes of debt crisis. All the same stuff. Futures game before Fed. Stocks, Euro rise on ECB. So we're getting a rebound in European stocks, helping US stocks as well higher. Obviously, this is all ahead of the. So we're kind of slifted slightly. The fact that the central bank's in trying to help, and is going to do something, hopefully, maybe, has given a relief rally, moving us back to risk on, although Bitcoin continues and crypto continues to go south. Just a little editorial article in here, a little interview with, with Carney, who's the former Bank of England governor, in a Bloomberg interview, saying that basically they should front load the rate rises, be more aggressive, because they're walking a fine line. It's better to now, get inflation under control, and then they can cut again aggressively if they need to, if we go into recession. Again, we've mentioned that Bitcoin falls to another 18-month low, meltdown deepens. In here, okay, so how it came to this, the Fed and White House slow inflation awakening. So it has been a slow awakening. It was only the end of last year, beginning this year, they were still talking of inflation being transitory. Janet Yellen, Treasury Secretary, chair of the Fed, got it wrong, said she got it wrong, thought it was going to be transitory, didn't think, and then, inflation would linger as long as it has. And now where we are is we're at the point of inflation, actually, we know the CPI data last Friday. And since that CPI data that we've had panic stations, and the panic stations have meant that, we're fully pricing in now. We've looked at this over the last few days. It wasn't there on Friday, but look, here we are for today's meeting, 15th of June, pretty much nailed on for a 75 basis point hike now. If they don't deliver You would think that rate hikes are negative for stocks, right? But the market wants a 75 now. If they only deliver 50, as even up to last week, Powell and the rest of the Fed were telling us they're delivering 50. If they only deliver 50, then the market is going to, as when I say the market, I mean the stock market. Stock indices are going to hate it. Bond markets will hate it because they're going to just see that the Fed are behind the curve, that they're going to have to be more, even more aggressive further down the line because they get behind the curve, and inflation will spiral, which will tend to push us into deeper recession. So they need to stay, what we say, is at least up with the curve. At least, so behind the curve means, this is what the curve is pricing in. This is what we're looking at now, is the curve. It's pricing in the market. It's what the market is pricing in. The curve is pricing in 75 today. The curve is pricing in, we go to the next meeting, another 75 in here. So for the July, we're looking at a total of 225 to 250. We're currently 75 to 100. So that's up 150. It's pricing in 275s with an outside chance of even a 75 and a 1%. If we get out to September now, current target 75 to 100. We're now the biggest chances here. In here, we've got 200 points of 200 basis points of rises. So that's really pricing in 75, 75, 50 in September. Remember, it was only a few weeks ago there was, some of the more dovish members of the Fed were talking about, who was it? I can't remember. It was, there was even mention of maybe a pause, through this, after the next two hikes, after the June and July hikes, maybe a pause, as we go through the summer and into September, maybe a pause in rate hikes. Well, you know what? The market now is telling us 75, 75, 50, and this is telling us there's a chance of 75, 75, 75. And they're obviously the real concerns, is that they get behind the curve. It gives us more inflation and deeper recession, but then aggressive rate hikes are going to potentially take us more quickly into recession. Okay, so that's a real concern. Okay, let's wind back to where we are. Where are we now? Where did I get up to on these? Okay, analysis, Fed behind the curve. Got to get back in front of the curve. So they need to deliver today in here. With blistering and regulatory, bond investors push for safety. So that's the market pushing. It's the market saying, basically, give us these rate hikes. So investors have drastically shifted their expectations about when decisions to a rate of 75, not the 50 that we were looking for last week. In here, and where are we here? US rate markets price in aggressive 75 hike. If they don't deliver, I think stocks are going to get crushed on. If they don't deliver, they need to deliver that 75. If they only deliver a 50, it's going to be, if they deliver a point, which is very, very unlikely, the market will probably really like a 100 basis point hike. Okay, it might initially jerk to the downside, but then could easily jerk back higher. Okay, focus on Fed clearly. Okay, futures edge higher, but futures probably edging higher. One for some short covering, and then probably as well in here, we're seeing, because of European stock indices are up on the back of the ECB having this emergency meeting. So you can see European bourses in here up about 1% today. And if we go to the stock indices, we've got in here having another slight down day. It was a marginal down day yesterday, not a big down day, but we're up about 0.5%, between 0.25% and 0.5%, depending on which index. Okay. So not a big rebound, but just maybe some short covering and getting a toe higher on the back of the Fed in here. You know what, guys? I do a lot of technical analysis with you guys every day in here. I really don't see a massive advantage of doing anything significant in here today, because it's all going to be on the Fed. I suffice to say, I'm just going to do a whistle top tour. I'm not going to go in at a deep dive, but we've got a positive tone running into today. If I'm going to trade ahead of the Fed, I'm probably actually trading from the buy side, trading from the long side today. Here's the Nasdaq, getting back up towards. So yesterday we had excuse me, we had this doji pattern. Doji patterns often a sign of indecision, or they are a sign of indecision. Could argue this is a long-legged doji. It doesn't look that long-legged because we haven't got big extremes. It's a fairly, relative to the bars around it, relative to the three big sell-offs, these three sell-offs that we had in here. The market in here is showing a far more net theme in here. So, it was a far more a narrower range, yesterday than the big negative candlesticks that we saw in the previous 3 sessions in here. Okay, and this is, sometimes this is a turning point. So just by the way, guys, so this is called often called three black crows. Okay, three black crows in candlesticks. Okay, when you get these long these big setups, sometimes it's three black crows, but sometimes it turns into four black crows. It can sometimes be seen as a bulletif. Okay, but often seen as a top, three to the downside, at the end of a bullish trend. But you can, it's really, so this usually comes at the end of a bull trend. You could argue, well, there's a little mini bull trend, and that signaled the end of that. But it can sometimes be seen towards the end of an uptrend, or at least a pause in an uptrend. And what we've seen in here is you've got this doji pattern. So it's not quite a long-legged doji because it hasn't got that longer legs, but signaling indecision. And obviously we're pushing back higher. So it's all going to be on the Fed. No surprises. We're getting kind of an indecisive signal ahead of, a huge event, the Fed decision, which has shifted literally in the last 72 hours from 50 to 75. But at the moment, if I'm playing it right now, you can see we've got impulsive bars on the 15-minute candle. Boom, boom. We're breaking high on the 15-minute. We're pushing up right close to, like, nudging at yesterday's. That's yesterday's high there. So you could argue this is a basing bottoming pattern going in. Play it from the long side for now, but obviously you're just keeping your powder dry for the Fed, and it's the same story in here for the S&P. So not quite as positive. We're nowhere near up towards yesterday's high in the S&P. We are on the Nasdaq. Again, though, you've got kind of this kind of indecisive doji pattern. Remember, in bear market territory, we broke, when we broke lower on, was it Monday? We went into bear market territory. So not as bullish there, for the S&P, but nevertheless, you can get rid of all this old analysis, all redundant. But if we get back above this more recent peak, there we're on the September contract in here, 37.74 and a quarter. It looks positive there for the S&P. So starting to look more positive. From a day trade perspective, yes, you can play it from the long side, but in the Fed, it's all going to be about being reactive. Let's go take a look at the commodity markets here. Oil had quite a negative day yesterday. So we made actually a new contract high, reversed lower, and went below the lows of the previous 1, 2, 3, 4, 5 trading sessions, 6 trading sessions actually. So we went below the low of the previous 6 trading sessions, having made a new high. That's a very negative signal. Okay, so it's seen as a recovery failure. I think that's a potential topping pattern in here. And if we go to the 15-minute chart now, so this looks like we had this surge high. It kind of fouls from just poking to a new high. You effectively get a double top when it broke down through that level there. So having surged high as it came back down lower, and then we do have a rebound going on now, though, so this is rebounding with the stocks rebounding. Difficult one to play. Again, you'd play right now. You'd be playing this from the long side. On a intermediate term basis. Not intermediate. Going into today, sorry, forget that. Going into the day, I probably want to short it if it gets back up here. But he knows that's a tricky one to play right now. Gold in here, recovery rally. That's with dollar. Remember, going back lower. Dollar's dipping back lower in here at the moment because we're seeing, if we go back to go look at the dollar, there's a dollar dipping back lower because we've gone back into kind of risk on mode. If I switch this to the daily chart on the dollar. So dollar back down, okay, having made a new high. Dollar was rallying with stocks going lower, safe haven dollar. Dollar down in here today, ECB meeting, relief rally coming to stocks. So we go slight minimally risk on. So dollar up, and then that takes us going back to gold in here on the daily. Gold rebounding with we're overcoming here the peak there from yesterday, and we go to the 15-minute. You can see we've just overcome the peak. Looks like a basing pattern, very impulsive the last half hour. So short term, we're in risk on, and it's being driven by this emergency ECB meeting in the very, very near term. If we step beyond that, then it's all about the Fed, right? And the Fed have to deliver 75. I think 75, the market probably likes 75 and goes up. 50, right? The market will probably collapse. 100, I don't know, but I'm going to go more to the side. It's going to be super choppy. Be super careful. You might want to put your hands in your pockets if they do 100, because the bulls and the bears will be out in force fighting to. Is that a bullish signal or is that a bearish signal, right? So, and you can go and ask, top fund managers, what they, if that's bullish or bearish, and you get, probably you ask 100, you get 50, you get 2 different answers, probably like near a 50-50 split, whether that's bullish or bearish. So, at the moment for me, that's probably bullish. but you'd have to be careful, right? Watch where the price action goes and try and jump on that price action. So, I think the Fed needs to over deliver or deliver at least 75 or over deliver. The chance of giving 100 is very, very slim. They're not going to go from 50 last week to now saying, right, we're going to go for 100, but who knows? If they want to get ahead of the curve, that's what they would do, but they're probably not going to. They're more cautious than that. But the chances are that they will need to deliver 75. If they don't deliver 75, the market's going to give them hell, and it'll be very, very painful on the downside. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Helmets and goggles at the ready for the Fed. And probably before that, we'll get something from the ECB. So if you see the market start moving, keep an eye on the feed that we have in the members area from Live School, the news feed, right? Keep an eye on whatever you watch, yeah? Keep an eye on Twitter feed, Live School's Twitter feed, yeah? Watching out to see if we get anything from the ECB. Because if they announce some emergency package, the market will probably like that. Well, the European markets will certainly like that. So we're going to have to wait and see what they come up with. I'm going to wrap it up there. Take care, guys. Have a good one. Stay safe. Bye.